Keystone is an independent equity research firm. We've been around for around 24 years. How do we work? Well, our analysts do the research. We look at every stock in Canada. That's about 3,500 stocks, 4,000 in the US every year. We look at them from a fundamental growth and balance sheet perspective. We help our clients build simple 15 to 25 stock portfolios. We want them to build that over a 12 to 24 month period. That they consist of quality growth and dividend growth stocks. You use a discount broker with our service. You subscribe to our research on an annual basis, and we provide you those reports on the dashboard on the website at www.keystocks.com. Those reports that have buy, sell, and hold recommendations on individual stocks are sent to you via email as well. Again, you can find information on us at www.keystocks.com. But why would you take Keystone's or my advice at all? Well, now I wasn't here at this conference last year. We had a scheduling conflict, but I did a money show in the fall of last year, similar to this conference in Toronto. These are the 4 small cap growth stocks that we recommended at that presentation. This is over a volatile period, and we presented the returns of those companies over that period. All of the companies here have reported solid earnings. They're growing and have pushed their share prices significantly higher. As we can see, 3 of the 4 have had very strong gains. The outstanding gains were from Hammond Power. Over the last 2 and 5 years and 1 year now, Hammond Power is the best performing stock on the entire Toronto Stock Exchange. We have recommended this stock for over 20 years. It is a basic, boring business. All they do is make transformers. And if they made Autobots and Decepticons, that would be awesome, but it's actually just power transformers that are used to step up and step down power to bring it into your home or bring it over long distances to travel. Now, they do have a little bit of sex appeal to the story. Hammond Power's transformers are used at every Tesla charging station in Canada. Now, you can see as well strong gains there from Viamed. In this past April, we elected to sell half our position. We do that at times when we have a stock do very well. We will sell out a portion of the stock or our original investment in the company. Calian, it's up modestly there, including the dividend. It continues to trade at low valuations, and we like it long term. Biosynth, which has done well, it's a cash-rich Canadian pharmaceutical company. We've recommended it for several years. It's implemented a dividend. There's about 30 million in cash in the bank, no debt. We like the company over a 2 to 4 year period. Now, I like to say, why are we here? Why are you here? Why do you do events like this? Anybody want to tell me why you are here today? Free food, maybe? Is that what it is? Is there? I don't know if that's on the menu today. I think I'm going to answer your question, okay? The question I'm asking you. I think you're here to make money, right? Like, that's what we're all here. And there's no shame in that. I love making money. That's why we do the research and alienate our families looking at 3,500 companies on an annual basis. We're here to make some money. Now, the one thing that I find is many people do this wrong. We look at hundreds of portfolios every year and thousands over the last 25 years. Often, individuals come to Keystone because they're dissatisfied with the returns in their portfolio and want a better option. From looking at these portfolios over the past 25 years, I can break this dissatisfaction, these 2 groups, into 2 areas. Essentially, there are those who have poorly constructed traditional big bank stock portfolios. These are portfolios that are consisting of or constructed of 5 to 20 mutual funds or ETFs. Each of those individual ETFs or funds owns 100 plus stocks. So you essentially own the market, all in the name of that magical word, diversification. Now, the problem is, while diversification is useful in its application, we have a problem with the application, essentially. In modern portfolio building, the application has become what we'd say bastardized. As the chart shows here, by owning just 20 reasonably diverse stocks, you have already achieved maximum diversification. Now, using the big bank method, essentially investors often own 500 to even thousands of individual stocks. That is what we like to call, wait for it here, wait for it, Diversification. That's about as funny as it gets in finance, so laugh it up. Feel free right now. That's all I got for you today. The second portfolio. This is not the way we would build the portfolio, the way the big banks often do it. What you get with this portfolio, and I'll get to the second way in a second. What you get with this portfolio is essentially a portfolio that is fee heavy, very complex, and that mirrors the market, but underperforms due to those high fees. So let's look at number two here. The second type of portfolio that we see individuals with that they're very dissatisfied with. And we would call this the pure speculation portfolio. This is a portfolio consisting largely of concept stocks, pre-revenue stocks, and potentially junior resource stocks. Now, for 25 years, I have watched with great curiosity and frankly, with a good bit of sadness, as well-meaning investors have built their portfolio this way. They're looking to quote unquote, strike it rich, or more accurately, create true wealth through the stock market. They take on undue risk in a misguided attempt to pursue this goal, only to often end in disaster if you build your portfolio this way. You do not have to build this portfolio this way. You do not have to take on undue risk to create a portfolio that has a fighting chance at creating long-term wealth. If you want to build true long-term wealth, I want you to chase cash flow, not concepts. The great thing is, this is a simple concept that I want you to walk away with from our little talk here today, because you will not hear this from most traditional financial advisors who stress mass diversification. It is a very, like I said, a simple concept. Investing in just 2 to 3 truly great stocks in your lifetime can be game-changing for your portfolio. But don't just take my word for it. Take it from Warren Buffett, perhaps the greatest investor of all time. Last year, he looked back in a retrospective on his investing career. In his 58 years of Berkshire Hathaway management, his satisfactory results, of course they were more than satisfactory, he's very modest, have been the product of about 12 investments. So let that sink in. What he is saying that only 12 investments in individual stocks in his almost 100 years on this planet have made him one of the richest humans here on Earth. Now, it does not take many, and perhaps most importantly, they do not have to be complicated moonshot businesses that promise to change the world. Often they are the most boring and mundane businesses out there. Buffett's greatest wins include Coca-Cola. They sell pop. It's not a game-changing business, but he's made hundreds of thousands of % on this business over time. Bank of America, it's a bank. American Express, and we all know that business as well. Again, all of these returning tens of thousands of % in his portfolio and for the shareholders of Berkshire Hathaway. Boring businesses, astonishing returns with less risk. That's what we're looking for. Now, I like to give real-world examples. These are the types of boring businesses from Keystones or our research. These are 4 actual recommendations over the past 20 years that we have recommended at Keystone. And they have changed the fortunes of our clients' portfolios. Now, Boyd, what do? How boring? They own automobile repair shops. Last decade, the best performing stock on the entire Toronto Stock Exchange. And we've been recommending them for 15 years. Hammond Power, like I said, they make electrical transformers. They've been around for around 100 years, a boring business. This is the best performing stock over the past year, 2 years, and 5 years on the entire Toronto Stock Exchange. Expel, they sell paint protection film. One of the best performing stocks over the past 5 years. Not Water Furnace, they make geothermal heating and cooling systems for your home. Again, not that sexy, but the returns are tremendous. Obviously, these percentages look impressive, and we display them at events like this to make us look smart. I'm typically here with my colleague, Aaron. He really needs that. I don't need it as much. I like to make fun of him when he's not here because he's a very large man and he can't come at me at that point. Now, in all seriousness, when I got started in the business, I was very green. as we all are. I was taught mass diversification, but found it a poor way to accumulate true wealth. As one hones your strategy, as we do over time, we have used now a strategy called focused diversification, and I'll briefly detail that in a moment. It's a strategy where our clients buy 15 to 25 stocks. That is the sweet spot. But what has helped solidify this singular piece of knowledge that I'm imparting on you today is some of the client stories we heard during the lockdown. Many people had a lot of time on their hands. Myself and Aaron made a conscious effort to be available, to listen. People were scared, and we could offer a calming voice at this time. Clients reached out to us via email. We have weekly chat sessions with clients as well. And we even got random tweets like this one. Now, we do a podcast as well. I encourage you to sign up and listen to it. This gentleman shared his investing story via Keystone on Twitter, or X, or whatever it's called today. We had a number of clients which reached out to us as well about holding a little bit more in Boyd over time, to give you an example of how powerful a great stock can create wealth in your portfolio. One gentleman invested $20,000 in Boyd about 13 years ago. It's worth over $2 million today. Boyd continues to be an absolute game changer, and we've never recommended selling a share of Boyd over the past 14 years. But it's not just Boyd, a client with roughly $1 million portfolio. The way we have our clients build our portfolio, if you're gonna buy 20 stocks, you have $1 million, 50,000 in each, equally weighted. So she bought Expel 6 years ago, put 50,000 into Expel. That 50,000 investment is worth 1.8 million today. So 6 years ago, her entire portfolio was $1 million. One investment within that portfolio today is worth 1.8. What I'm saying is, again, this is to show you how much of an impact a truly great stock can have on your portfolio over time. Now, your question should be a couple questions, really. First is, how can I find the next Expel, the Boyd, the Hammond Powers of the world, the water furnaces? And how do you construct a portfolio to capitalize on these great capital compounding stocks? Now, as far as the profile as a stock that we're looking for, we have literally created 3-hour webinars on this. So I don't have enough time to get into that today, but suffice it to say, what we're looking for is great cash flow producing businesses with good management that trade at reasonable prices and have a long-term track record and a long path of growth ahead of them. Now, number two, if you want to address that, would be how the concept of creating this portfolio. How do you capitalize on that? Now, first, what you cannot do is build it in the traditional big bank portfolio model. Even if one of these great stocks makes it into your portfolio, if you own 500 to 1,000 stocks through an ETF, it truly will not move the needle for your portfolio over time. What we advise you to do is take control of your portfolio. If you want to beat the market, that's what you're all here to do today. You cannot just be the market. When you buy 5 to 10 to 15 ETFs or mutual funds or 100 stocks in your individual portfolio, you're owning thousands of stocks. You are the market. What you need to do is create your own simple equity portfolio. This is the strategy we call focused diversification, not mass diversification. Again, you start off, you buy 15 to 25 stocks over a 12 to 24 month period. Why? It reduces risk to exposure to short-term market corrections over time. There may be a correction coming, there may not, but if you buy over your first year, 12 stocks, and there's a correction, you can buy the rest of those 12 at a lower price, and you can add to those positions over time. There's no perfect way of doing it, but this is the best strategy that we've found over the past 25 years. It provides flexibility also to add to new positions as new research comes out. We're always looking at new companies. Right now, for example, we're looking at 2,000 US stocks with a market cap of under $1 billion that screen for cash flow and growth. And we'll likely have new recommendations that come out of that report. As those come out, you can add to those over time. Now, what's the process? If you want to start building your portfolio based on your own advice and do that today, or you want to use our advice, you can start essentially with 3 to 5 new positions. Add 2 to 3 new stocks each quarter, every 3 months, as new research is released, or you find new individual companies that match a good criteria of cash flow and growth ahead of them. Now, particularly during a recession, if you see that coming, you don't need to buy a full position. Say you're buying 10,000 in each stock, a full position would be 10,000. A half position is $5,000. You can do what is called layering into that position over time. We give advice specifically on this with individual recommendations that we put out, or you can do that within your portfolio as well. Now, where do we think quickly the opportunities are before I get through those stocks? We see the market is bifurcated right now. After a terrible 2022, 2023 was a great year for the indexes, particularly US stocks. They were powered by the mega cap 8. These are the Alphabets, the Google, Alphabet is Google, the Alphabets, the Apples, the Netflix, the Metas of the world. Now, they power 27% of the entire S&P 500. So where are the opportunities here? This is bifurcating the market. They were powering the returns over the past year is what we're essentially saying here. So we can see a tremendous valuation gap here in terms of favoring small cap growth-oriented stocks. Now, if you look here at the PE here on the mega cap 28 or mega cap 8, it's 28 right now. If you look at the S&P 500, 19. But if you look at the mid cap and small cap indexes, essentially you're looking at 15.5 PE. So the disparity right now where the value that we see in the market is good quality small cap and mid cap companies. To give you an idea and put this in better context, you should look at this chart. This is since 2005. The S&P 600, which is the small cap index, traded at a premium historically over time to their S&P large cap 500 counterparts. Now you can see it is flipped and there is a premium for the large caps. This chart again shows that and shows how the valuation has swung towards or in favor of small caps. Of course, not all small cap companies are opportunities, nor should all large caps be avoided, but there could be a significant opportunity opening up for long-term investors in the small cap sector. Okay, let's get to quickly a couple of those companies we like right now. Dynacor. We're at a resource conference here, so this is apropos. They are not a miner, though. They are what we call a miller. They purchase ore from government-registered producers in various regions of Peru and then process them in their wholly owned milling facility, which produces gold and silver. It's primarily gold, though. Dynacor has a very simple business model. They get a margin between the price of ore purchased and the market price of gold. The higher the margin, the better. Throughput also helps, so the more ore they're pushing through their mill, the better. And a higher gold pricing environment, as we're seeing now, encourages more small-scale miners to bring that ore to the mill. Now, you can see this is originally in our coverage around the $1.40 to $2 range. We like it right now. It's just under $4, pays a good dividend, but I'll show you the valuations. When we originally recommended it, they didn't have a dividend. They implemented that and have increased it 5 times. Our effective yield is now 8%. We expect them to increase that dividend this year as well. But why do we like Dynacor? Well, it has 11 consecutive years of profitability, which is basically unheard of in the gold sector. A very strong balance sheet. About 33% of this company's market cap is in cash and it has no debt. So it can self-fund growth going forward. And you can see here, strong growth added not by issuing shares, but from internally generated cash flow, all while paying a growing dividend. You can see that cash has built up on the balance sheet. It can now use that to grow the business going forward. It is a dividend growth stock. Boring, but we like it. All of those companies that we looked at, the 4, were dividend growth stocks. The Hammond Powers of the world, the Boyds, the Expel, and the last one was Water Furnace, dividend growth stocks. We love that model. Since it introduced its dividend in 2018, this company has aggressively grown it every year since 2019. It pays out of only about 25% of cash flow as its dividend, and it increased it once again about 16.5% this year. Reasonable valuations, which is what we like. You can see here, this is over a 3-year period. It took a pause in terms of growth last year, but that's the type of growth we like to see. Again, this is the last quarter. Tremendous growth in revenues, almost 40%. But EPS up 250% in the last quarter. In March of this year, the company will report record results for this past year as well. So our thesis here, again, strong dividend growth payer, grows that over time. It has the balance sheet to grow. This is where we really think the juice in terms of where this company could have upside 3 times over the next 3 to 4 years. They have an existing mill. They've increased the capacity there, but they want to replicate that mill. They have the cash on hand to do another mill in Peru, build it up to where their current mill is at 500 tons per day to 600. They can go into another South American country, and they will start likely this year with a pilot project in West Africa. So this, if they can replicate the success without issuing shares in other markets, that's growth at a reasonable price, and that's why we like it. There's our fair value on it right now. The company only trades at about 6 times earnings when you pull the cash out, so it's good value. Okay, the next company I'll look at, we love companies with great cash in the bank and they are able to acquire in downtimes. This is what this company can do. I'm going to move through it fastly. They're a software business, 2 areas, interactive management group, and the, I'll pull it back if I can, and the AGM, which is the asset management group. They make call center software, essentially. That's the bread and butter of the business, but they acquire other businesses from the internally generated cash flow without issuing shares. That's what we like about the business. They're a turnaround story. This is their last quarter. It's a significant turnaround. We've owned this stock since it was in the $3 range, $4 range. It's today in the $30, $35 range. We think it's worth $40 to $45. But this is the turnaround that we're seeing in terms of earnings and EBITDA. It was not able to acquire businesses during the pandemic because everything was too expensive. They paused, and now things are becoming more cheap, more in their range of valuation guidance that they look for in terms of acquisitions. We expect significant acquisitions over the course of this year from the $250 million they have in the bank. And again, you can see there, I'm going to quickly go through this, but they're deploying capital now at a rate that we haven't seen for about 5 years, which is great to see. They traded about 9 times EV to EBITDA, which is what we like, relative to the peer group, which trades at 16 to 17 times. So it's cheap relative to their peers. We like it right now. The next company I'm going to talk about is Viomed. You saw them. We recommended at the similar conference last year. They're a provider of durable medical equipment, non-invasive vents that are used for people with COPD, end of life. So it's used to improve their quality of life and take them out of the hospitals in the US. It's a better way, a cheaper way for the system and a better quality of life for their patients. We've owned this company since it traded in the Canadian, about $3.80 range, $2 something US. They used to trade on the Toronto Stock Exchange. Now they've exclusively gone to the NASDAQ. We like them. We sold half about a year ago in this range. Now we're buying it again. We think it offers growth at a reasonable price. You can see this is what we like to see, growth in terms of revenues, EPS, and EBITDA. We expect that going forward. We expect that they'll be able to deploy the capital that they have to make acquisitions, but it's really an organic growth story. We expect this company to grow at 20% in terms of organic growth on an annual basis. It's grown beyond that for the past 8 years. We expect it to continue to grow at 20 to 25% plus organically. All right, let's move to the last company that I'm going to look at today. This is what we call a turnaround story. Originally recommended it in about the $1.60 range. Trades around $1.80, $1.70 now. Geodrill, they are a driller primarily in West Africa, but they're moving out of that region throughout Latin America as well. Their fair value, we have it on right now, is about $250, trades around $170. We think it's also a takeover target. But to give you an idea of this company's growth trajectory, you can see every year in terms of revenue, there's some little hiccups there, but the trajectory is like this over time. The earnings is like this over time. They had a bad debt expense that they had in their last period. We expect that to be rectified over the next 3 months. The second half of this year, return to growth. You buy this business now for what it can do over the next 2 to 3 years, and we think it's a takeover target as well. We think it may be acquired over the next 5 years. All right, that's going to end it for me today. Thank you very much.